Is the consumer slowdown a valid excuse, or is this more a Netflix problem or a broader streaming problem?
Yeah, Sarah, good afternoon. Thanks for having me. Look, I think this is precisely what's impacting the stock so sharply today. It's just the uncertainty around that. And it felt like, as you listen to the company in the newsletter and the call yesterday, that in some respects are kind of grasping at straws. And I think it's a little bit of everything. And I think as you think about the consumer, I think without question, they are facing at least some incremental pressure in parts of Europe and Latin America. That seems to be where the more acute macroeconomic pressures are today. It's not clear they're really seeing that in the U.S., but the reality is 3 of their 4 major regions saw a decline in subscribers. I mean, the lone positive grower was Asia-Pac, which is much earlier for them. So it's a combination of macro, but also, reaching a penetration ceiling much more quickly than expected in some of their more mature markets. And I think that surprised them.
So, Will, on the stock, you were neutral going in. So I guess you're feeling pretty good, not recommending it to shareholders, even though it was already down double digits sharply for the year. Though I was looking at the Fidelity retail data, very heavily bought stock among retail traders today on this dip. Is that a wise decision?
We're still at a neutral rating. I think there's still a lot of uncertainty ahead for the stock. And look, this is a classic broken stock right now. I mean, the company aspires to be a double-digit grower. We're only forecasting 7-8% growth this year, something comparable next year. And until you see an inflection point on growth reaccelerating, which they're betting on some new initiatives to help with, including trying to monetize password sharing, introducing an ad-supported model over time. But until you have greater confidence in that inflection, it's tough for me to see what the catalyst is going to be to get the stock working again here, even on the weakness.
Is the growth story dead, Mike?
Well, yeah, I mean, the hyper-growth story is dead. The idea that the overall pie is growing so fast that effortlessly and with password sharing, Netflix can continue to meet its subscriber growth numbers, that seems to be past. I don't think overall growth is dead. TV is going to be internet TV. If it's part of a bundle, it's going to include Netflix at the core of it. So I don't think it's really that desperate, but the transition or the consideration of a lower-priced advertising-supported tier of Netflix, a lot of folks thought that was a matter of time. It probably makes a tremendous amount of sense, but it's a less clean story than it has been for Netflix, where we have pricing power.
Well, because then what happens to subs?
Yes, and
right?
So presumably people would go from wanting to pay $15 for the ad-free level to downshifting or trading down to a cheaper one. I do think they'll be phenomenally successful at gaining advertising market share in a hurry, because the brand marketer business is desperate to reach digital eyeballs. If you consider how many eyeball hours are out of reach of advertisers right now, the fact that Netflix is going to open themselves up is going to be welcomed by the industry. It just doesn't necessarily mean for Netflix's own bottom line it's going to be a quick score.
What do you think about that, Will? And what would happen then to the billions of dollars they've been spending on content? Doesn't that economic model get broken? Because if they lose a bunch of subscribers, they can't fund it as well.
Well, yeah, actually, I think the economic model is probably still okay, because they'll be able to recoup fees from the advertisers, right, to supplement, what they're not receiving directly from subscribers relative to today. And I do think it provides an incremental opportunity, particularly in international markets where they're earlier and customers might be more price sensitive, right? It's important to remember that cable services relative to Netflix pricing in international markets, particularly in parts of Asia Pacific, India, Indonesia, Thailand, et cetera, Netflix looks relatively expensive. So being able to introduce a lower price service to the end consumer could help stimulate demand, which ultimately helps stimulate revenue. But part of the challenge for them here, Sarah, is this is probably more of a 2024 event. This isn't something they've even started to work on in a significant fashion yet. So it's not going to be a stock or revenue mover here for a couple of years still.